welcome to the deep dive. Ever wondered why, some stocks barely move when big trades happen, but others can swing quite a bit?
Mm-hmm. It's a really common observation.
Yeah. And today we're digging into something called impact cost.
Yeah,
It really explains this, especially for big indices like the Nifty 50.
exactly. We looked into this, and impact cost is key. It's all about how smoothly stocks trade.
So our mission today is to sort of unpack what impact cost really means and why it's so important.
Right. We've got a good breakdown of what it is, the calculation behind it, and some examples to make it clearer. It really comes down to the price of moving the market when you trade.
Okay, so let's start there. At its core, what exactly is impact cost? Break it down for us.
Sure. Think of it basically as a measure of liquidity. How easily can you buy or sell a stock without, pushing the price around too much?
Okay, liquidity, so ease of trading.
Precisely. It's shown as a percentage. That percentage tells you how much the price might move for a specific trade size.
So a low percentage is good.
Yeah, low impact cost means high liquidity. You can trade big amounts and the price doesn't shift much. Very efficient.
High impact cost.
That means low liquidity. Even moderately sized trades can make the price jump or fall quite a bit. Much harder to trade efficiently.
Right, okay. So if I want to buy, say, a lot of shares in a company and it has a high impact cost, my own buying action could drive the price up against me.
That's exactly it. Large buy orders increase demand, right? So they push the price up. And big sell orders do the opposite, push it down.
Makes sense.
Impact cost measures the gap between the price you thought you might get the ideal price before your trade hits the market and the actual average price you end up executing at.
Ah, okay. Is there like a formula for this? How do they calculate it?
Yep, there is. The percentage is calculated like this. You take the actual execution price, subtract the ideal price, then divide that difference by the ideal price and multiply by 100.
Okay, actual execution price minus ideal divided by ideal times the 100. What's the ideal price, though?
Good question. The ideal price is basically the midpoint. It's the average of the best bid, the highest price a buyer will pay, and the best ask, the lowest price a seller will take.
The middle of the bid-ask spread. Okay.
Exactly. It represents the fairest price, kind of, before a large order disturbs things, and the actual execution price. That's just the average price you paid for all the shares needed to fill your order. It might not all happen at one price point.
Got it. That clarifies the calculation. Now, you mentioned the Nifty 50 earlier. How does impact cost connect there?
Yeah, this is where it's really critical. Low impact cost is a major criterion for a stock getting into and staying in the Nifty 50.
Really? Why is that?
Well, the National Stock Exchange, the NSC, they want the Nifty 50 stocks to be, stable and reliably tradable, especially for big players like institutional investors who move large volumes.
Okay, so they need to be able to trade without causing chaos.
Precisely. The NSE actually calculates the impact cost for a standard hypothetical trade. I think it's 1 lakh over a 6-month period for stocks they're considering.
And what are they looking for? What's the target?
They generally want that impact cost to be below 0.1% for Nifty 50 stocks.
0.1%. That sounds tiny for a 1 lakh trade.
It is tiny, and that's the point. It signifies very high liquidity.
Why is that specific threshold so crucial?
For those big institutional investors, that low cost is a huge advantage. It means they can buy or sell large blocks of shares without significantly moving the needle on the price. Their execution is closer to the ideal price.
Minimizes their trading costs, essentially.
Exactly. If a stock had high impact costs, say 1% or more, large trades would constantly jolt its price. That makes it unsuitable for a benchmark index like the Nifty 50. It could undermine market stability and investor confidence.
So the NSE uses it as a sort of stability check.
Absolutely. It helps keep the core market efficient and predictable for large participants.
Okay, this is starting to click. Could we walk through maybe a couple of examples
Yeah,
to see the difference?
definitely. Let's take stock A. Imagine it's a big liquid Nifty 50 stock, maybe like a Reliance Industries, trading around 2,000. Okay.
You want to buy 1 lakh worth. That's what, 50 shares? Because it's so liquid, there are probably thousands of shares offered just slightly higher, say at 2,000 to 2.
So plenty of sellers right near the current price.
Right. Your whole 50-share order likely gets filled easily at 2002. If the ideal price was, say, 2008, the impact cost calculation might come out to just 0.1%. Very low.
Because the price barely moved to fill your order.
Exactly. Shows high liquidity. Now let's take stock B. Maybe a mid-sized company trading at 500.
Okay, less liquid maybe.
Probably. You want to buy a 1 lakh worth again, so that's 200 shares this time. You look at the order book. Maybe there are only 100 shares offered at the best ask price of 502.
So you can't fill the whole order there.
Correct. To get the next 100 shares, you might have to go up to the next offer, maybe at 505.
Ah, so you're paying different prices.
Yes. Your average execution price wouldn't be 502. It might be 503.50. If the ideal price was, say, 500, your impact cost might jump to something like 0.7%, noticeably higher.
Because your trade had to climb the ladder of offers.
That's a good way to put it. Now, for the extreme, stock C, a small, thinly traded company at 100.
Okay, very low volume probably.
Right. You want 1 lakh worth, which is 1,000 shares. You might find only 200 shares available at 102. Then maybe 300 more at 105.
Still not enough.
Nope. You might have to go all the way up to, say, 110 to buy the remaining 500 shares.
Wow, it's a big jump.
Huge jump. Your average execution price could end up being something like 106.90. Compared to an ideal price of maybe 100, the impact cost could be massive, like 6.9% or even higher.
Ouch. So that 1 lakh trade really moved the market.
Dramatically. It shows how difficult and costly it is to execute large trades in illiquid stocks.
Those examples really paint the picture. So just to recap the main points.
Yeah, let's summarize.
Okay, so for highly liquid stocks, like in the Nifty 50, you're looking for a very low impact cost, like under 0.1%, meaning big trades don't disrupt the price much.
Correct. Efficient trading. For less traded stocks, the impact cost could be much higher, maybe over 1%, meaning even moderate trades can significantly move the price. High cost of trading.
Uh-huh. Less efficient, more risk of price slippage.
And the NSE uses this metric, specifically that low threshold, to ensure the Nifty 50 stocks are stable and suitable for large institutional trading, which helps overall market health.
That sums it up nicely. It's a vital sign for market efficiency and stability, especially concerning large trades.
So you can really see how impact cost isn't just some obscure technical term. It's a really practical measure of how easily a stock can absorb trading activity, vital for the big players.
Absolutely. It reflects the market's depth and its ability to handle volume without, getting knocked off balance.
And what's quite fascinating is realizing this number, this impact cost, is sort of working behind the scenes to underpin the stability of these major indices that so many people follow and invest in.
It really does highlight those perhaps less visible mechanisms that keep the financial gears turning relatively smoothly. It's not just about the company's performance, but also how its stock behaves in the market.
Yeah, it really makes you think. Which brings us to a final thought for you, our listeners. Knowing about impact costs now, how might this influence the way you look at stocks for your own strategies? Especially if you ever anticipate making, larger trades down the line. Something to consider.